Thanks for clicking. RBC, and really the government, are propping up the Toronto condo market. This according to a new report coming from the Toronto Star. Yeah, and we've discussed Toronto's condo crisis on this channel before, with condo investors being unable to close on their purchases, homes not appraising for their purchase price, value slipping, and buyers are walking away from their sales. Yet, as we'll see today, RBC is providing a solution, with implicit government support, issuing blanket appraisals to help prop up the market. And while this is an issue all unto itself, the government's silence on this, given that the practice doesn't adhere to OSFI's guidelines on prudent underwriting, yet it's front page news and has been happening for a long time, gives us some insight into potential government support for house prices should they continue downward.
Oh, Papa! There, my little crap.
So what I want to do today is very briefly go over the Toronto Star article, taking a look at what RBC has been doing to prop up the Toronto condo market, go over the extent to which this practice is allowed or ignored by the government regulators, and then discuss what this can tell us about potential government support for the market should current uncertainties hit the fan in the coming months and years ahead. Speaking of government support, the Bank of Canada is set to make its next policy rate announcement on Wednesday and hold a press conference thereafter, and we'll obviously have an update out on both on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into this article. Onto the GTA condo market and RBC propping it up. First off, just a brief refresher, back in the heydays of the housing market boom in 2021, etc., thousands of buyers purchased pre-construction condos at peak prices. Many of these buyers never planned on actually buying the home themselves and didn't qualify for a mortgage on them, but rather they figured, or were told, that they could double or triple their money by selling the condo prior to close in 3 or 4 years' time.
That's not how I remember it.
And of course, those properties are no longer worth the purchase price that was agreed to back in 21 and 22, with many of them losing between 10 and 30% of their value. As such, the majority of banks and lenders won't lend on these properties as OSFI, Canada's banking regulator, restricts the maximum loan-to-value on investment properties to 80. So for a quick illustration, let's do the math. Say you agreed to purchase a condo back in 2022 for $800,000, and it drops 30%, now worth $560,000. The max loan the lender can now offer is $448,000, meaning you need to bring $352,000 to the table to make up the difference. $352,000 as a down payment to the lender, or you get sued. Unless, that is, RBC is offering to do a blanket appraisal, meaning RBC is using the value of a pre-construction property at the time the buyer entered into a purchase agreement rather than the updated value at the time the property closes. So under the previous scenario, RBC just does a blanket appraisal for $800,000. The buyer puts $160,000 down and now owes $640,000 on a condo that is only worth $560,000.
That's smart.
And RBC is doing this on any number of projects. According to the Star report, in March of 2024, one of the developers held a realtor appreciation event, which I imagine, but I can't give any confirmation, looks something like this. Sorry, that's actually a multi-level marketing conference, which, given today's article, is a distinction without a difference. Regardless, according to the Star, one developer had a realtor appreciation event back in 2024 where it advertised to these realtors that 5 of its condo towers all had blanket appraisals with RBC. So the realtors got some cocktail weenies, a few free drinks, and now can push this great opportunity to their clients.
Have I got an opportunity for you?
So, in summary, RBC does these blanket appraisals, appraising these properties for their purchase price rather than their current market value, and these, usually investors, get to close on their properties. Awfully nice of RBC, right? Well, says John Pasalis, they're actually doing it for themselves, noting that lenders have financed the construction loan, so if there are too many defaults, the entire project can't close, the whole project falls apart. So there is a good chance that RBC actually did the financing for these condo projects from the beginning. Meaning, if these projects don't close, if all these homes fail to close, then RBC could already be in trouble. They could be out millions upon millions of dollars already. Yeah, it's kind of like reading a prelude to The Big Short, isn't it? With the big question being, how is this even allowed? Well, according to the Office of the Superintendent for Financial Institutions, OSFI, It really shouldn't be. If the loan to value is anything above 80%, then that loan needs mortgage insurance. But you can't get mortgage insurance like CMHC, etc. on an investment property, which most of these are. Notwithstanding, of course, those purchases where the buyer pretends it's for personal use, the bank turns a blind eye, takes less than 20% down, also known as fraud.
No, that doesn't happen.
So, since you can't get mortgage insurance on those properties, the lender is limited to providing loans up to 80% of the property's value. And obviously, RBC is getting around this rule by saying, well, we appraised it, we provided a blanket appraisal, and the LTV is still 80% or under. But OSFI doesn't really allow that either, as when using automated valuation methods, OSFI says that the banks should have processes in place to monitor their ongoing effectiveness in representing the market value of the property. Not the market value 3 years ago, the market value. Why not use a market value from 2012? Everything will pass.
I think I have what just might be an idea.
Which, obviously, RBC doesn't appear to be doing that. Though RBC says they are, telling the Toronto Star, our property valuation methods, including appraisals on pre-construction properties, are based on a number of market conditions, including those at the time of financing decision on a mortgage application is made. So yeah, Canada's banking regulator says that the banks need to monitor the effectiveness and accuracy of their appraisals, and in some type of Orwellian doublespeak, RBC says that they are. When even John Passalis says that RBC could be doing million-dollar mortgages on properties worth $800,000, and the regulator says nothing. It is not as though the regulator doesn't know that this is happening, even if it weren't on the front page of a major newspaper. OSFI was explicit in its 2025 risk outlook that the condo market in the GTA was under major pressure. Which leads me to the real point of the video, the extent to which the powers that be, the government, will allow house prices to fall if the you-know-what hits the fan. OSFI is clearly turning a blind eye to the actions being undertaken by RBC to prop up the real estate market in Toronto. And we discussed earlier as to why RBC has millions upon millions tied up in these condo developments. It doesn't want to see thousands upon thousands of underwater loans go bad, as that could cause even more problems for the government, not only with having to bail out the banking sector, but if those loans go bad, if we see a real plunge in the market, the government's on the hook for all of those insured loans, which would also be affected by the falling property values. And this isn't the first time that we've seen tacit support for property prices coming from the government. It was only less than a year ago that former Prime Minister Justin Trudeau said that house prices need to retain their value. And then we saw some major loosening of the rules to achieve that objective just a few months later, with the government insuring 30-year mortgages.
Don't cry.
And these loosening of the rules, or flat out ignoring old ones, tells me that we should be cognizant that the government could do whatever it takes, or at least try to do whatever it takes, to make sure that house prices do not fall. While we could indeed see some major pressure on the housing market in the months and years ahead, and we could see the Bank of Canada constrained in how much it can cut rates to support that housing market, while simultaneously not seeing much help in the bond market, which would tighten fixed rates, don't be surprised if the fiscal authorities loosen up the rules some more to try to prop up this market. They don't want to see a banking problem, they don't want to see prices plunge, they don't want to see their tax revenue fall, and they don't want to be on the hook for all of those millions upon millions, maybe even billions of dollars worth of insured mortgages that they have guaranteed. The government has an interest in trying to keep prices up, and I wouldn't be surprised to see them pull those levers at its disposal, or at very minimum, as we're seeing now, ignore the levers being pulled by other interested parties. How all of this plays out remains to be seen, but we will obviously continue to track how current uncertainties affect the real estate markets in this country. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.